Hey everybody, this is Ryan Mallory, and how do you put into words what we just saw this week? It was one of the craziest, most volatile weeks of trading you will ever see. It's on the level of 1987, the 2000 .com bubble crash, the 2008 Great Recession, that kind of volatility. In fact, this past week of trading, we've never seen that kind of volatility since 1929 when Herbert Hoover was president. That's getting pretty crazy, okay? All right, let's look at the S&P 500 chart going all the way back to 2016. This trend line, it broke below it on Thursday, so it took some technical damage, only to break back above it on Friday in the final 30 minutes when Trump had his presser and the market rallied. However, there's some huge resistance right overhead here, okay? So there's a very good chance this is a dead cat bounce, because when it tests this resistance, maybe it tests it on Monday, very good chance of that. If it does, there's a strong likelihood it's going to come right back down. That's what they call a dead cat bounce. What is a dead cat bounce? Well, in literal terms, imagine dropping a dead cat from a high distance. Even though it's dead, it's going to bounce, but it's still dead. This is your dead cat bounce possibly here. If it goes into this resistance and struggles, and then you start seeing the sell-off, it's probably going to be a dead cat bounce. How far can it drop? Well, you have a major support level underneath here. We have not tested it yet. We got very close to it on Thursday and possibly started to look like we were going to test it on Friday until the market finally rallied. However, this is a key support level here. This goes all the way back to 2015. So far it has held up very well. You can see there's all these different points of interest here that has touched it in the past. Very good chance we see a test right there. It'll be absolutely imperative for the markets to hold this support level if the market weakens again next week. So what happens if we can break resistance? What happens if we can break through this resistance level and things start to improve again next week? Let's say the cases start to go down. Can we break above this resistance level? That would be the next staging point, I think, for the shorts to probably reload their short positions. I'm not overly confident we're going to see 3,100 anytime soon. That would be a massive rally. That would have to be a huge change of perception about this coronavirus. And here's the problem with the coronavirus. It's shutting down the entire economy. It's not like the airlines are just getting hit. It's not like energy's getting hit. My son's baseball league has just been canceled. Schools are being canceled. People are being told to work from home. People who are working hourly wages because they work at a bar or they work at a restaurant, they are getting canceled because nobody's wanting to go out and eat. People are going to start staying away from these things because there's been this mass panic produced by the media. A lot of it's unnecessary, guys. We had the swine flu. Yes, this is a little bit more deadlier than the swine flu, but we had 60 million Americans get hit with the swine flu. So the market's not panicking necessarily about the coronavirus, it's panicking over how everybody's panicking about it. And this is what you get here. You get this massive sell-off here that because the economy's shutting down, if there's no earnings being produced, if businesses are closing up for at least now, Walt Disney World's not taking any customers, that's all lost revenue. So the market's going to have an adverse reaction. It has to price this in. And guess what? The Federal Reserve, they're kind of limited on what they can do this time because it's not like a banking crisis where they just need to inject some liquidity into the system. You can't create earnings for companies if people can't leave their houses. But back to the S&P 500, because this support level is very critical. If it's a dead cat bounce, good chance we're going to go see this level next week. Where it gets really dicey, if we break through the December lows of 2018, that would be those really crazy lows that we saw in quarter four, late 2018. Those could easily get tested next week if this market falls back apart. So you're going to want to mark 2346 on your charts for the S&P 500, because if that breaks, we've got a big topping pattern just confirmed. I'm 100% cash in my trading portfolio right now. I don't stand to benefit from a 10% move higher or lower come Monday morning. I'm just trying to lay out the facts for you here. I know it's not all that optimistic. I don't have a lot of faith in the bounce that we just saw on Friday afternoon, but I need to lay out the different scenarios here because I think it's important for you to know going forward so you can make the best decisions for yourself when you do your own due diligence. Now check out this beige line right here. It connects the lows back in 2014 to the lows from 2016. And yeah, it's 1800. Could we get that low? Yeah, if nobody goes to work and everything just keeps shutting down, there's a good chance that we're going to see a huge plunge here. It's very possible. Now you're probably saying, no way that happens. Well, let me tell you, I did not think that late February we're going to be talking about possibly retesting December lows. But here we are. We're very close to testing the December lows from 2018. So anything's possible at this point. Yes, we are extremely oversold. But it's one thing when you're shutting down an entire world economy. How are you going to produce earnings? Now let's look at the weekly chart here, a very long-term chart. It goes back to the .com top, and it also goes back to the top from 2008. It creates a massive support level underneath. Possible. Do I think it'll test it? I'm not quite sure. I think right now it's a low probability, but it's something to be taking note of right now. If we were to have a major market correction, you would want to watch this 1581. Even more importantly is this rising trend line if this coronavirus continues to plague the market for the rest of this year, because looking at the monthly chart, look at this. Going back to 1975, we have a massive long-term trend line. And you want to know something? It kind of coincides with this red line here. So there's a lot of support there. Again, I'm not saying that we're going to this level, okay? But the more knowledge that you have, the more power you have for the stock market and understanding what is going on here. This is a massive support level. And while I don't think it's going to hit this level, I don't think it'll get to that extent, but it's worth laying out all the scenarios here for you. But as you can see, over time, we have tested this trend line at numerous points. There was a big gap between 1982's test and then the test that we had in 2008, 2009 when it bottomed. But look at that, it returned. And now it's been quite a while since we've tested it, since 2009. So yes, there is a possibility that this market can't figure out this whole coronavirus, that yeah, it could retest this level. It would be a massive drop. All right, let's look at the NASDAQ. Look how high it got in the .com. It got all the way up to 5140. But when that bubble finally burst, it went all the way back to like the 1100s, okay? Then he says, well, the market always comes back. Yes, but can you wait for it to come back? Because look what it did. It took forever for it to come back. Not until 2015 did we ever get back to those highs again. So again, I'm not trying to say that the S&P 500 is going to lose over 80%. Not what I'm saying at all. I'm just trying to say that there can be some major moves in the market, and you have to prepare yourself for it. That's why I always say manage the risk. You have to manage the risk. If you don't, all this is for waste. Manage the risk. Anytime you get into a trade, always know where you're going to get out if it doesn't work out for you. All right, let's look at the VIX index, the volatility index, the fear index, whatever you want to call it. Anyways, it is pretty darn close to reaching the levels that we reached in 2008. It took like 10 months to get to these levels. We've done it in about 3 weeks, a little more than 3 weeks. It's really extreme right now. It's pulled back off of the high some to 57, but that is still very elevated. In normal markets, where are we usually at? I don't know, like 12 to 14, this little area here. So to be all the way back up as high as like 78, this is like very troubling times right now. And there's not a lot of precedent for it. You have 2008, and then you also have 1987. Outside of that, there's no other levels on my charts that can compare to what we've seen this week. Look guys, I know this week has been really hard for so many traders, so many investors. The IRAs, the 401ks, 403bs, they're all taking hits. Individual brokerage accounts, they're freezing up when you're trying to sell or when you're trying to buy. It's crazy out there, okay? Volatility, it's going to be a long time before you ever see something as volatile as this market again. This is crazy volatility. At some point, yes, it will go away. The markets will rebound, okay? But in the meantime, you need to manage the risk. You have to know what you can handle, what you can tolerate, and you have to know before you ever get into a trade, before you ever get into an investment, where are you going to get out at? Because if you don't know that, you're doomed to panic. And panic is what leads to losses. So don't do that, okay? Keep your heads up. This too shall pass. And God bless you all.